Welcome to Book Summary Podcast, your gateway to personal transformation. Each episode delivers big ideas from the world's most impactful books on mindset, productivity, and success, all in just a few minutes. Ready to turn knowledge into action? Let's get started.
Okay, let's unpack this. Imagine, for a moment, an art collector named Heinz Berggruen.
Name rings a bell. Major figure. Right?
Exactly, a formidable figure in the art world. And over his lifetime, he acquired literally thousands of pieces of art. Thousands.
Wow, that's quite a collection.
It was monumental.
Yeah.
But here's the kicker. When people look back, analyze the collection, a staggering 99% of those pieces, they end up having little to no real long-term value.
99%. So basically duds, financially speaking.
Pretty much. But, and this is the really counterintuitive part, it didn't matter. Not one bit.
How could it not matter if 99% fail?
Because the remaining 1%, well, that 1% included works by masters like Picasso, Matisse, Klee, undisputed heavyweights.
Okay. The absolute best of the best.
Right. And those didn't just appreciate a little. They exploded in value, made him stupendously rich, cemented his legacy.
So his entire success, all that wealth and reputation, it basically hinged on just a tiny fraction of his effort, that 1%.
Precisely. A tiny, tiny fraction. Wild, isn't it?
It really is. It goes against how we usually think about effort and reward.
Totally. Or, okay, consider another icon, Walt Disney.
Disney. Everyone knows Disney. A creative genius.
Absolutely a visionary. But we often gloss over the early struggles. His journey wasn't smooth sailing at all.
Right. I think I've heard bits and pieces. Wasn't there a bankruptcy early on?
There was. His very first animation studio, Laugh-O-Gram Studio, went bankrupt, flat out.
Bankrupt? Wow, The guy who built an empire started with a bankruptcy. That's something.
It is. Right. And even after that, for years, he produced hundreds of cartoons. Mickey Mouse shorts, silly symphonies, stuff we now consider classics.
Beloved stuff, yeah. Groundbreaking animation for the time.
Groundbreaking, charming, but commercially, most of them lost money.
Lost money, really? Even Mickey Mouse?
The early ones, yeah.
Yeah.
They were expensive to make, innovative, sure, but often unprofitable. He was constantly struggling financially.
So just grinding it out, basically.
Exactly. Until everything changed. One film.
Let me guess. Snow White.
You got it. Snow White and the Seven Dwarfs. Comes out in 1938. And it wasn't just a hit. It was a phenomenon. Unprecedented.
I remember reading about that. It was huge, right?
Huge doesn't even cover it. It earned an astounding $8 million in its first 6 months. That was astronomical back then. Think hundreds of millions today.
$8 million in 6 months?
Yeah.
In 1938 dollars. That's mind-boggling.
It earned more than all his previous work combined, many times over.
Wow. So that one film.
It changed everything. Transformed the company, paid off all their debts. He gave bonuses to his key animators, kept the talent.
That's crucial, retaining the talent.
And it allowed him to buy a brand new state-of-the-art studio in Burbank, where Disney still is today.
So it literally built the foundation for the empire we know, secured his legacy.
Absolutely. That one film.
It's incredible how one single event can have such an outsized impact.
Exactly. And these aren't just, quirky stories about famous people. These examples point to something deeper, a profound, often overlooked truth about how success really works, especially in the world of money.
A truth that kind of pushes against our intuition, maybe.
Definitely pushes against our intuition. It challenges our basic assumptions about effort, reward, how things should work. Which brings us here. Welcome to the Deep Dive,
where we peel back the layers on your sources
and extract the most important nuggets of knowledge and insight. We help you get truly well-informed, cutting through the noise.
Glad to be bigging in.
Today, we're embarking on a really fascinating deep dive. It's a concept that, honestly, flips a lot of conventional thinking on its head. It's called Tails, You Win.
Tails, You Win. Okay, intriguing title.
It is. And our insights today come from a really insightful book that offers a shortcut, if you will, to understanding the often counterintuitive psychology of money. Super relevant for anyone navigating their personal financial journey, especially here in the U.S.
Yeah, what's fascinating here, and often, like you said, quite surprising, is how we're all kind of trained almost instinctively to look for consistency. Steady patterns, incremental progress.
Right, like school grades, climbing the career ladder, step by step.
Exactly. We're taught, consistent effort equals consistent proportional results. Put in X, get Y. A nice, clean, linear relationship.
That's the expectation.
But this deep dive, it's going to reveal that the biggest results, the real game changers, the things that truly move the needle, they often come from a surprisingly small number of events.
Exceptions, not the rule.
Precisely. These are what statisticians or finance folks call the long tails of a distribution, the extreme outcomes.
Okay, long tails. Let's define that a bit more.
Yeah, it's not just some academic jargon. This insight is absolutely crucial for you listening, whether you're actively trying to build wealth, just trying to make sense of the market's ups and downs.
Which can feel pretty random sometimes.
Totally random. Or even if you're just aiming to make more informed decisions about your financial future overall. It's about understanding why these few outliers end up dictating the majority of outcomes.
Well, it's not just what happens, but the underlying why.
Exactly. And recognizing that can really encourage a shift in your thinking. A profound shift, actually, about where true success comes from and, importantly, how you position yourself to maybe catch one of those tails.
Okay, so let's really drill down into this long tails idea. Move beyond, say, the standard bell curve we all learned about in school.
Right, the normal distribution. Everyone pictures that symmetrical hump shape. Most things cluster around the average, and extreme events are rare and don't have a huge impact on the total.
Yeah, that's the typical picture.
But in finance, and actually in a lot of real-world systems, we often see something different. It's more like a power law distribution.
Power law. Okay, so what does that look like?
Well, it's not symmetrical. Those tails, the extreme ends, the really rare outcomes, they stretch out much further than in a bell curve. And crucially, they have a disproportionately massive influence on the overall result.
Disproportionately massive, like the 1% of Berggrun's art.
Exactly like that. These are infrequent events, yes, but their impact is huge. It's not the 80-20 rule, where maybe 20% of your effort gives you 80% of the result.
Which is already pretty skewed.
Right. But in a tails you win world, it can be way more extreme. Like 99% of your efforts yield almost nothing, and then 1% yields almost everything, or even crazier ratios.
Wow. Okay, so why is that so hard for our brains to grasp? Why is it so counterintuitive?
It's a great question because, like we said, our minds seem hardwired for linearity. We expect cause and effect to be proportional.
Put in an hour at the gym, expect to get a little bit stronger, write a page, expect the book to be 1 page longer.
Exactly. Predictable. If I buy 100 lottery tickets, I expect, maybe a few small wins, not one giant jackpot that makes all the losers irrelevant.
Right. We don't naturally think in terms of extreme outliers dominating everything.
But in reality, especially in areas like innovation, business, finance, outcomes are often exponential, not linear at all.
Exponential, meaning?
Meaning you can put in consistent effort for ages, feel like you're getting nowhere, spinning your wheels, and then suddenly one tiny breakthrough, one successful product, one lucky investment, that rare tail event yields the vast majority of the rewards. It dwarfs everything that came before.
Like pushing a button 999 times and getting nothing, then hitting the jackpot on the 1000th press.
That's a perfect analogy. And that nonlinear reality, it's incredibly hard for our brains to process. We misjudge risk, we misjudge reward, we misunderstand what success actually looks like in these domains.
Okay, let's bring back Heinz Berggruen again to really hammer this home.
Good idea. The 99% failure rate.
Right. Thousands of pieces acquired over decades. And let's assume, as the story suggests, 99% were essentially failures or duds financially. They held value, maybe, or more likely lost value, became irrelevant.
Imagine the psychology of that. Buying piece after piece and most just fizzle.
It must have taken incredible conviction. But the value generated by that tiny 1%, the Picassos, the Matisses, was so monumental, so overwhelming.
That it made the whole thing a massive success.
A resounding success. It perfectly illustrates this core idea. You can be wrong most of the time. You can pick hundreds of duds, make dozens of bad calls.
And still come out incredibly wealthy.
Stupendously wealthy. As long as your wins, when they happen, are truly enormous. Those powerful tail events.
So it's not about your batting average necessarily. It's about the magnitude of your hits.
Exactly. It's not about being right often. It's about being profoundly right once in a while and making sure you're in a position to capture that profound rightness when it shows up.
Which brings us back to Disney. That story also fits this pattern perfectly, doesn't it? Especially in creative entrepreneurship.
Absolutely. Before Snow White, his career was just a constant struggle, despite his talent and innovation.
That bankruptcy in 1923 with Laugh-O-Gram, nearly penniless, forced him to move to California.
That's rough.
Really rough. Then he starts again with his brother Roy. Makes hundreds of shorts through the 20s and 30s. Mickey Mouse arrives, the silly symphonies, Innovation everywhere. But, as you said, unprofitable. Most of them. Expensive to make, hard to finance.
A relentless grind. Constant financial pressure. Lots of small creative wins, paradoxically leading to big financial losses or near misses. The studio was often right on the edge.
Until Snow White. And didn't he have to, bet the farm on that one?
He absolutely did. Mortgaged his house. People in the industry called it Disney's folly. Nobody thought audiences would sit through a feature-length cartoon.
Disney's folly. Wow. The pressure must have been immense.
Immense. But the impact? Transformative. Artistically, sure, but financially. That $8 million in the first 6 months.
Which, adjusted for inflation, is huge, but more importantly, it was just vastly more than they'd ever earned before.
Orders of magnitude more. It fundamentally reshaped the company. Paid off debts, gave them stability they'd never had.
Allowed him to keep his key animators with bonuses.
Critical move. And fund that state-of-the-art Burbank studio, the house that Snow White built, essentially.
And it made Walt himself a household name, an international celebrity. Even got him that special Oscar with the 7 little statuettes.
Right. It wasn't just a movie. It was a cultural and financial earthquake for him.
So if we connect this to the bigger picture, Disney's story isn't about slow, steady gains. Not at all.
No, it's the absolute opposite.
It's one massive outlier success, completely wiping out the memory and financial impact of years of struggles, losses, even bankruptcy.
It really highlights that idea. Anything huge, profitable, famous, influential, it's almost always the result of a tail event.
And we underestimate how rare and powerful they are because, well, we only really pay attention to the successes, right? We see Snow White, we see the finished Picasso.
We don't see the hundreds of failed shorts, the discarded sketches, the years of experiments that didn't pan out.
Exactly. We see the tip of the iceberg, the glorious outcome, but we miss the vast, unseen bulk of failures and near misses beneath the surface that made it possible.
That is such a critical point, and understanding this tails you win idea is so eye-opening, especially for us here in America, where entrepreneurship and investing are such a big part of the culture.
Definitely. And you see this principle applied very deliberately in certain fields.
Like venture capital, right?
Yeah.
VC firms seem to live and breathe this stuff.
They absolutely do. Their entire business model's built around it. They are maybe the most explicit practitioners of the tails you win philosophy.
How so?
Well, they expect most of their investments to fail. They go in knowing that. Often 50, 60, 70% of the startups that back will just go to zero. Poof.
So failure is the baseline expectation.
It is. They hope some will do okay, maybe return the initial money or a small profit, but that's not where they make their money.
They're looking for the exceptions.
Exactly. They fully anticipate that maybe only 1 or 2 bonanzas, 1 or 2 spectacular home runs out of a whole portfolio of dozens of companies will generate all the fund's returns, sometimes more than all the others combined.
So it's not just a gamble, it's a calculated strategy based on finding those outliers.
Highly calculated, a deliberate, disciplined pursuit of those long tails, knowing full well most seeds won't sprout.
And there's data backing this up, isn't there? That Correlation Ventures study.
Yes, that study is incredibly revealing. They looked at over 21,000 venture financings between 2004 and 2014. A huge data set.
Okay, 21,000 deals. What did they find?
The results were stark. A staggering 65% of those investments lost money. 2/3 failed to return capital.
65% lost money.
Wow. Only 2.5% made 10 to 20 times their money. Good, but not legendary. And even tinier 1% made more than 20 times.
Okay, getting rarer and rarer.
And here's where it gets really interesting. The extreme tail. A minuscule 0.5%. That's only about 100 companies out of 21,000 earned 50 times or more on the initial investment.
0.5% generated returns of 50x or more.
That's right. And that tiny fraction, that 0.5%, is where the vast majority of the entire venture capital industry's returns came from during that decade.
Unbelievable. So the whole industry is basically funded by these super rare, massive successes.
That's the model. It's not the average investment. It's those exceptional, unpredictable few that carry the entire load. Imagine the mindset needed to keep investing knowing that.
Yeah, the discipline to stick with it, knowing most bets fail, but your entire success depends on finding that 1 in 200 or even rarer gem.
And they embrace it. They don't just tolerate being wrong, they build their strategy around it because they are laser focused on finding those few massive wins.
So, okay, this makes sense for high-risk VC, maybe for art, maybe for movies. But what about regular investing, like The stock market, the public markets where most of us put our retirement savings.
That's the crucial question, isn't it? Does this tails you win principle apply there too, in the seemingly safer world of established publicly traded companies?
Yeah. Because our intuition says no, right? Investing in big established companies feels different, safer, more predictable.
That's the common assumption. We think of blue chip stocks as steady climbers, less prone to dramatic failure than some scrappy startup.
But the data might tell a different story.
The data tells a very different story, surprisingly. The public markets beneath that surface appearance of steady growth are also profoundly driven by these same tail events.
Really? How so?
Well, consider that JP Morgan asset management study. They looked at the Russell 3000 index.
Which is like almost the entire U.S. stock market, right? Thousands of companies.
Exactly. Represents about 98% of the investable U.S. market cap. They looked at it from 1980 onwards. A long time frame.
Okay. And what did they find within that broad market?
The findings were pretty jaw-dropping. An astonishing 40% of all the companies in the Russell 3000 during that period lost at least 70% of their value and never recovered.
40%. Almost half the companies basically cratered. These aren't just startups. These are established public companies.
Established public companies, household names among them in many cases, they effectively failed as long-term investments.
Okay, that's shocking.
Yeah.
But wait, the Russell 3000 index itself did incredibly well over that period, didn't it?
Phenomenally well. It increased more than 73-fold since 1980, a spectacular return for anyone who just held the index.
So,
Yeah.
how is that possible if nearly half the components were disasters?
This is the mind-bending part. The study found that effectively all of the index's overall gains came from just 7% of its component companies, the massive outperformers.
7%. So less than 1 in 10 companies drove all the growth.
Pretty much. The index's success wasn't about avoiding the losers. It was about capturing the enormous gains from a tiny minority of massive winners.
While the other 93% were either mediocre or outright failures.
Exactly. It tells you that even broad market investing, which feels diversified and safe, is still fundamentally a bet on finding and holding those unpredictable outliers.
Could you give an example? Like one of those companies that failed?
Sure, think about Kuroko Pictures. Big deal in the 80s and 90s. Produced Rambo, Terminator 2, Basic Instinct. Huge blockbusters.
Yeah, I remember Kuroko. Big name back then.
They went public in '87, hit a $400 million market cap. Seems successful, but then a few big flops, financial trouble. Bankrupt by 1996. Stock went to zero.
Wow. From Rambo to zero.
And Kuroko's story isn't unique. It reflects what happened to 4 out of 10 public companies over time. Rise, maybe some stability, then collapse.
So the index success comes from the Microsofts, the Walmarts, the Apples.
Yeah.
The huge winners that more than offset all those Kurokos.
Precisely. Enough massive winners dwarf the impact of all the duds.
And we still see this today, right? You mentioned Amazon and Apple in 2018.
Yeah, a great recent example. In 2018, just those 2 companies, Amazon and Apple, were responsible for a combined 13% of the entire S&P 500's returns for the year.
13% from just 2 companies out of 500.
Driven largely by Prime and AWS for Amazon, and the iPhone ecosystem for Apple. These are like tail events within tail events. A few dominant products driving the success of already massive companies, which in turn drive a huge chunk of the overall market return.
It's layers of tails.
It really is. And it's fascinating to think even the people working on those specific projects, like the engineers building AWS or designing the iPhone, they often have tail careers themselves, given how incredibly hard it is to get hired at places like Google, Facebook, or Apple.
Right. The hiring rates are notoriously low, like 0.1 or 0.2% sometimes.
Exactly. Success is concentrated at every level: individual careers, specific products, company performance, market returns. It's tails all the way down, in a way.
Okay, so what does this all mean? For you, the individual investor, trying to navigate this, especially here in the U.S., where we value financial independence.
It's a huge implication.
Yeah, this understanding of tail events, it really changes how we should think about our own behavior, doesn't it? We get so focused on making individual good decisions, picking the right stock, timing the market.
Trying to be perfect with every move.
Right. But maybe the most crucial moments aren't about what we do, but what we don't do. Like not panicking.
That's a huge part of it. Not losing your head when everyone else around you is freaking out, when the headlines are screaming doom and your gut says, sell everything.
The source mentions Napoleon's definition of a military genius.
Yeah, I love that quote. The man who can do the average thing when all those around him are going crazy.
And the book argues that's the perfect definition of an investing genius.
It really is. It's not about flashy moves or brilliant predictions. It's about quiet, steady resilience during chaos. Almost boring discipline.
Because most financial advice focuses on today, right?
Yeah.
What to buy now, what sector is hot.
Always focused on the immediate next step.
But over your whole investing lifetime, the decisions you make during just a few critical days, probably 1% of the time or less, those days when panic or euphoria grips the market.
Those decisions will matter far more than everything you did on all the other calm days combined.
Those are your personal tail events, the moments that define your long-term outcome.
Exactly. How you handle those extremes.
There's that thought experiment in the book, Sue, Jim, and Tom investing $1 a month from 1900 to 2019.
Right, a great illustration. Sue just invests consistently every single month, no matter what, rain or shine, never sells.
Just steady Eddie, or steady Sue in this case. Then there's Jim.
Jim tries to time the market. He invests when things look good, sells when a recession hits, saves cash, then jumps back in when the recession ends.
Trying to avoid the downturns. And Tom.
Tom is slower, more like how many people react emotionally. He sells 6 months after a recession starts, after feeling the pain, and only gets back in 6 months after it ends, when things feel safe again.
Okay, so 3 strategies. What were the results?
The results are incredibly striking. Sue, the steady, boring investor, she ends up with $435,551.
Wow. Okay, what about Jim, the market timer?
Jim has way less, $257,386.
Ouch. Almost half as much. And Tom, the slower reactor.
Even worse, $234,476.
Good grief. So Sue, just by sticking with it, crushed the others.
Crushed them. And think about it. Over that long period, about 22% of the months were during or right around recessions, just over a fifth of the time.
So by simply keeping her cool and staying invested during that relatively small, scary fraction of the time,
she ended up with almost 3/4 more money than the guys who tried to be clever or reacted emotionally.
that just powerfully highlights it, doesn't it? Doing the average thing consistently during the crazy times is the key. It's emotional discipline, not market timing.
Absolutely. It's like that pilot analogy you mentioned.
Right. The job is hours and hours of boredom punctuated by moments of sheer terror.
And an investor's success, it's not determined by the boring years on cruise control. It's determined by how you handle those moments of sheer terror.
Those market crashes, deep recessions, panics, when everyone's screaming, sell.
Those moments are your tail events to manage. Your reaction dictates almost everything.
Which connects directly to this idea of normalizing failure, right? And embracing experimentation.
Exactly. Because if success hinges on these rare, unpredictable wins, it means you have to accept that a lot of things won't work. Peter Lynch even said it.
The legendary Magellan fund manager, what did he say?
He said, if you're terrific in this business, you're right 6 times out of 10.
6 out of 10. So even the best are wrong 40% of the time.
40%, that's crucial. It tells you investing, business, finance, they're not like flying a plane where one mistake is catastrophic.
Right. You can't be wrong 40% of the time flying a plane.
Definitely not.
Yeah.
But in these fields, experimentation, trying things, accepting failures, managing them, it's part of the process, expected, necessary even. It's a game of probabilities and outliers, not perfection.
And we see this in big, successful companies too, like Amazon.
Absolutely. Jeff Bezos, after the Fire Phone flopped, a huge public failure.
Yeah, that was a big flop.
He was totally candid. He basically said, if you think that's a big failure, we're working on much bigger failures right now. Some will make the Fire Phone look like a tiny blip.
Wow, that takes guts. But it's that tails you win understanding, isn't it?
Totally. He knew that massive successes like AWS or Prime, which were also big risks initially, would ultimately dwarf and pay for all the failures. The tails rescue the averages.
And Reed Hastings at Netflix, pushing for more canceled shows.
Same logic. He thought their hit ratio was too high. It meant they weren't taking enough risks to find the next huge culture-defining hit like Orange is the New Black or Stranger Things.
So a higher failure rate could actually be a sign of a better strategy for finding those blockbusters.
In their view, yes. You have to be willing to produce and cancel many shows that are just okay or moderate successes to find the ones that really drive the business. Accepting failure is part of the path to outlier success.
And part of why this is hard for us is we usually only see the finished product, right?
Yeah.
The successful outcome.
Exactly. We don't see the losses, the duds, the messy process, like the Chris Rock analogy in the book.
Ah, yeah, the comedian. Explain that.
Well, the Chris Rock you see on Netflix, polished, hilarious, every joke lands. Looks like effortless genius.
Yeah, seems perfect.
But The Chris Rock performing in small clubs for months before that? He's testing material, fumbling, cutting jokes that bomb. It's a messy process.
So the Netflix special is the highlight reel, the tail end of hundreds of attempts.
Precisely. The good jokes are the tales that survived from a universe of trial and error. And it's the same in investing in business. We see the wins, the successes are celebrated, the failures, mostly hidden.
Okay, let's unpack this even further with maybe the biggest name in investing. Warren Buffett.
The Oracle of Omaha himself.
Even he, despite his legendary status, his decades of success, the vast majority of his fortune came from a surprisingly small number of investments.
Is that right? I always assumed it was steady genius across the board.
He actually said it himself. He's owned maybe 400 to 500 stocks in his life, a lot of different companies.
Okay, quite diversified over time then.
But he made most of his money, the overwhelming majority, on just 10 of them.
10 out of 500. That's incredible concentration. That's pure tails, you win.
Absolutely. And Charlie Munger, his longtime partner, put an even finer point on it.
What did Munger say? He usually cuts right to the chase.
He did. He said, basically, if you remove just a few of Berkshire's top investments, its long-term track record is pretty average.
Average, wow. So without Coke, Amex, Geico, those huge long-term winners.
Buffett's performance would look much less extraordinary. Maybe just good, not legendary.
Yeah.
It wasn't about small, consistent wins everywhere. It was about a handful of absolute monster winners held for decades.
Those were his tails, and he let them run.
Exactly. So what does this all mean for you listening right now, thinking about your own money, your own future here in America?
It's a fundamental shift in perspective, really.
Yeah. It means your own failures, your losses, the investments that go sideways, the business idea that doesn't work out. They aren't weird exceptions. They aren't necessarily signs you did something wrong.
They're normal, expected, part of the process.
Right. What really matters is what George Soros said.
Another legend, what was his take?
He said, it's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong.
Ah, the magnitude again. Maximize the wins, minimize the losses.
Exactly. You can be wrong half the time, maybe even more, and still make a fortune. If your winners are big enough, and crucially, if you don't let your losers wipe you out.
Let the winners run, cut the losers short. Understand that the winners, the tails, are what ultimately drive your success.
So this raises an important question then. How should this deep understanding of tail events actually change your practical approach? What do you do differently?
Great question. It's not just theory. It has real actionable implications. 3 big ones come to mind.
Okay, what's the first one?
First, and maybe most critical, broad diversification.
Diversification. We hear that all the time, but why specifically in light of tails?
Because those winning tails, the next Microsoft, the next Amazon, the next big thing, they're fundamentally unpredictable. You can't consistently pick them ahead of time. Nobody can.
So trying to pick individual winners is a losing game for most people.
It's extremely difficult, bordering on impossible over the long run. So the only reliable way to ensure you're exposed to those rare, powerful outliers, to even have a chance of capturing them, is to hold a broad, diversified portfolio, like an index fund that owns the whole market.
So diversification isn't just defense, it's offense. It's how you make sure you own the winners when they emerge.
Exactly. It's not just spreading risk, it's maximizing your odds of participating in the market's tail-driven growth. If you only own a few stocks, you could easily miss the handful that drive almost all the returns.
Okay, broad diversification. Makes sense. What's number 2?
Number 2, unwavering patience and endurance.
Patience. Also sounds familiar, but connected to the tails.
Well, the magic of compounding, where your money starts making money, only really works its wonders over very long periods, decades.
Right. Time is the key ingredient.
And those long periods, they are guaranteed to be filled with failures, market crashes, recessions, bad news, moments of sheer panic. You have to stay in the game long enough through all of that noise and volatility.
For those rare tail events to actually happen and for compounding to kick in.
Exactly. And it's not just passive waiting. It's actively enduring. Enduring the fear, the uncertainty, the urge to sell when things look bleak, because those pressures are what shake out the impatient investors.
Leaving the spoils for the resilient.
Pretty much. If you panic and sell, you risk missing the very best days or month or years in the market, which is often when the majority of the long-term returns actually occur, often right after the worst periods. You have to be there for the recovery tail.
Okay. Diversification, patience, endurance. What's the third implication?
The third one is fostering a genuine acceptance of individual loss and imperfection.
Accepting loss. That's hard for people. We hate losing.
We do. But understanding tails helps. Realize that failure on individual investments or strategies isn't weird, it's normal, expected, necessary even.
Like Bezos, Hastings, Buffett. They all had way more failures or average outcomes than huge successes.
Right, so don't get discouraged by duds in your own portfolio. Don't overreact. They are part of the landscape of long-term success. Your journey isn't about being right every time.
It's about being present, resilient, patient.
So that when those few big opportunities do arise, you're still in the game to benefit from their outsized impact. Focus on the whole portfolio, the long game, the cumulative effect of the winners, not every single pick or short-term dip.
You know, what's really striking is how universal this principle seems to be. It's not just finance or business.
Right. It seems to pop up everywhere.
The book even makes the point about life itself.
Mm-hmm.
Think about it. Out of maybe 100 billion planets just in our galaxy,
An unimaginable number.
only one, as far as we currently know, has intelligent life capable of, well, having this conversation.
We are an astronomical outlier, the longest tail imaginable.
The very fact that you, listening, exist and can ponder these ideas is the result of an almost infinitely improbable series of events, a cosmic tail event.
That's a humbling perspective.
It really is, and maybe that perspective can shift things for us, move us away from trying to control everything, predict everything, avoid every failure.
Which is exhausting and impossible anyway.
Exactly, and move us towards appreciating the incredible rarity and power of the events that do truly move the needle, whether it's a massive investment win, a scientific breakthrough, meeting the right person.
It encourages resilience, accepting that things go wrong, efforts fail, but the few big successes are what ultimately shape the outcome.
It kind of frees you from the tyranny of needing constant incremental perfection, right? Makes you more open to the surprising, unpredictable nature of real breakthroughs.
Yeah, understanding uncertainty and the concentrated nature of success, that's powerful.
So let's recap today's deep dive. We've explored this powerful, counterintuitive idea, tails, you win.
Seeing how just a small minority of outcomes drive the vast majority of results in art, movies, VC, the stock market, everywhere.
We saw how even legends like Disney and Buffett built their success not on consistent small wins, but on a few spectacular outliers that overshadowed countless failures or average results.
The key takeaways for you are pretty clear.
Right. Embrace that unwavering patience. Diversify broadly to make sure you catch those unpredictable tails. And crucially, don't get discouraged or paralyzed by the things that don't work out. Accept imperfection.
Because it's those few big winners, combined with your resilience to stay in the game through thick and thin, that truly build lasting wealth over time.
Which leads to maybe a final provocative thought for you to chew on.
Okay, let's hear it.
If our financial success is so heavily driven by these unpredictable, powerful tail events, if it's less about constant, perfect decision-making and more about positioning and endurance,
Then what does that imply about how we should define wealth itself, or even happiness?
Exactly. Maybe true financial wisdom isn't just about maximizing the number in your bank account. Maybe it's more about understanding what that money can really buy you.
Things beyond just more stuff.
Things beyond measure. Finding that balance between striving for gains, sure, but also recognizing the immense value of the intangible benefits money can unlock. Benefits that truly impact the quality of your life.
Interesting. So what is the biggest intangible benefit money can buy?
Well, that leads us perfectly into our next deep dive. Understanding the psychology of money isn't just about making and keeping it. It's ultimately about what that money buys for you that goes beyond the material.
Okay, I'm hooked. What's next?
Next time, we'll delve into Chapter 7, Freedom. We'll explore why the highest, most valuable dividend money pays isn't the fancy car or the big house.
What is it then?
It's the ability to wake up every morning and say, I can do whatever I want today.
Control of your time, freedom.
Exactly. We'll see how money, viewed through the right lens, can genuinely make you happier by giving you unparalleled control over your most precious, finite asset, your time.
Looking forward to that one. That sounds like true wealth.
Thanks for tuning in to the Book Summary Podcast. If you found value in today's episode, hit that like button. Subscribe for more summaries and share it with someone who's ready to grow. Want deeper insights, exclusive book notes, and reading tips? Join our free newsletter. The link's in the description. And don't forget, if you'd like to read the full book, our affiliate link is right below. It helps support the channel and keeps the summaries coming. Until next time, keep reading, keep growing.